here's a little exercise. Let's look at the 330 strike puts. And these are put options. You guys can tell they're put options because the higher we go in strikes, the higher the price of the option. The index is at 342 right now. That's the cash value. What will the 330 puts be trading for if the index moves up or down $5? Now, some people will know instantly by looking at this option chain right here what that answer is, but some people won't. So I'm going to just show you a cute little trick that works, and it works very well. Let's assume that the market is at 342 right now. And we want to know, we're buying these 330 puts, and we want to know what they're going to be worth if the market goes down, say, $5. Well, this is in the OEX, and we know that the strike prices in the OEX are $5 apart. What are these options going to be worth when the market moves down one strike or $5? It's real simple. Some of you guys are going to look at this and just say, you know what, this is a cool little trick. All we have to do to find out what these options are going to be worth if the market moves one strike is to look at a different strike. Now, it's not, for those just learning this, it's not real commonsensical, but think of it this way. When the market's at 342, how far out of the money are the 330 puts? Just think it through in your head for a second, and you're going to say, well, they're $12 out of the money. And the answer is correct. Now, let's say that the market does move down $5. Okay, the market is currently at 342, and it's going to move down $5. That's going to put it at 337. How far out of the money will the 330 puts be trading when the market's at 337? And the answer is real simple, 7. So if you want to know what these options are going to be looking or trading at when they're $7 out of the money, you just look at which option is currently $7 out of the money, and that'll tell you. Right now, with the market at 342, the 335 puts are $7 out of the money. So if the market moves down $5 exactly, the options at the 330 strike that are trading for 2160 are going to go to 2450. The math is real simple. And if the market moves up, the options are going to go the other way, and they'll look like the 330 puts will look like the 325 puts, and they'll go to $19. So if the market moves up one strike, we're going to lose $2.60. If the market goes down one strike, the options are going to go from 2160 to 2450, and we're going to make $2.90. That's real simple. All you do is moving strikes around to see where the market would be if the market moved one strike. Now, we're going to use this little trick going forward to show you a little bit more practical way of how these broken wing butterflies work and just how protected you guys are. People, I would not be teaching you this if I didn't think this was a great topic. I would be teaching you something else. So watch how neat this gets. Let's say we're looking at the March 9th, 2009 option chain in the OEX. The OEX at that time was 325.12. But it works like this no matter what date you pick or what volatility you pick, it's still going to work the same way. Here's the option chain. All we're going to concentrate on for right now is the strike prices, which start at 400 and work all the way down to 290, and the option prices, which start at 76.80 and work down to 770. Over in the third column we have here is the spread. That'll be explained to you in a little bit. Don't even focus on that right now. Just worry about the first two columns, the strike and the option. Now let's say that we want to buy a traditional butterfly. we want to go out and buy the 330, 315, 300 put butterfly. And we go and we look and we see that the 330 puts are trading at 2160, the 315 puts are trading at 1470, but because we sell twice as many of that, 1470 times 2 is 2940, and the 300 puts are trading for $10.10. If we do the math on that, we see that the butterfly is trading for 230. And as you recall from previous slides, I showed you the comparison of the profit and loss chart at expiration of the traditional butterfly versus the broken wing butterfly. And I said that the traditional butterfly is trading for 230. This is where I came up with the prices. This is actual closing prices. You can go back and look at the date, and you'll see that these are real numbers. Now you'll see that the traditional butterfly, even though it's $15 wide, which means we can make $15, the most you can make on a butterfly is the distance between the strikes. We're risking 230 to make 15, which is a fairly decent risk to reward ratio. It still has $2.30 of risk. And I know there's a lot of people listening in that have bought a butterfly for around 230 and watched that thing go out worthless and didn't feel like, wow, this was risk averse. I'm glad I did the butterfly. I'm glad I played it safe by buying a butterfly. A lot of people are sitting there saying, I can't believe I just lost $2.30 on something that had very little risk. Well, let's take a look at what the broken wing butterfly would look like and compare it to this traditional butterfly we've been discussing. Okay, let's say that we moved the 300 put down to the 290 put. Instead of buying the 300 put for 1010, we bought the 290 put for 770. Now the math comes out where we can buy this for a 10-cent credit. Okay? So instead of risking $2.30 if the thing goes out worthless, if the thing goes out worthless on the broken wing butterfly, we receive the 10-cent credit. We get to keep that. It'll at least offset our commissions, hopefully. Okay? The difference between paying $2.30 and receiving 10 cents is huge. Don't underestimate that. On just 10 contracts, it's $2,400 on one single trade. I know almost everybody listening in has probably lost $2,400 on a trade and was not happy with it. Okay? But let's take a look at how these things operate as the market moves. It's the same option chain we're looking at. We're looking at the broken wing butterfly now, and you'll see that the arrows point at the 330 strike, the 315 strike, and the 290 strike. What does that mean? Well, the difference between 330 and 315 is $15. And the difference between 315 and 290 is $25. This is a $15 by $25 broken wing butterfly. So, as going back to our examples we were discussing earlier, the naysayers say this has $10 of risk, and to a large extent, they're right on a break-even basis at expiration. But let's take a look at how these things actually move and operate. Again, we can buy this broken wing butterfly for a 10-cent credit. Okay?